Hi, everybody. Good morning. Thank you so much for joining us for this webinar. We'll wait for another couple of minutes for more people to join, and then we'll begin. Okay, great. I think we can begin. Again, thank you so much, all of you, for joining in for today's webinar. We're going to talk about a very simple topic. It's called Save Like an RD, but also Earn More Than an RD. And this is what SIPs can do for you over the long term. Right? We're all very familiar with recurring deposits or, RDs. And, they're very simple, safe. It helps us build a savings habit. But what if there was something smarter, right? Something that works like an RD, but it helps your money sort of grow even faster. Right. So today in this webinar, we'll talk about SIPs and how they compare with RDs. We'll keep things rather straightforward, focus on real numbers, and maybe by the end of this session, I hope to be able to give you an understanding of, how it can be, how SIPs can be called a smarter version of an RD. So let's begin by talking about how RDs work. I'm sure most of us, have probably used one, or we've definitely heard about it. So what an RD is essentially is that it's a fixed monthly saving instrument that you open with any bank. Right? You choose any amount. Let's take 5,000 rupees a month, right? And the tenure can be anything: a year, 3 years, 5 years, or a few months also, right? So every month the same amount gets deposited and you earn a fixed rate of interest. Currently, about anywhere between 6 to 7%. Right. Now, why do people flock towards this sort of an investment? Is because it's safe. And another point is that your returns are guaranteed. There is no market risk. These are three things that any investor looks for because it's one of the reasons why they probably settle for a lower uh, rate of return as well. It is because it's safe and the returns are guaranteed and there's no market risk that they settle for something much lower, where in hindsight, there is actually a better option which can give you better returns. It will build your savings habit or sort of build that discipline in you a little bit more, right? But given all of these advantages in an RD, there is a catch. I mean, it's not one catch, there are multiple catches. A, inflation, B, taxes, and there are multiple missed opportunities, right? So let's take a very quick example. Let's say inflation is at 6% and your RD earns 6.5%, right? Now, after taxes, your real return is close to zero, right? So you're essentially not getting anything out of it, correct? So while this RD helps you save, it does not necessarily help you build that wealth, which is what an SIP can do for you. This brings me to the next slide, which is that SIPs are smarter RDs. Now, what is an SIP? Very similar to an RD. It's a disciplined way to invest in mutual funds. Just like an RD, you commit a fixed amount every month. It can be 5,000, 10,000, or it can be as low as even 500 rupees a month. A lot of AMCs are now coming up with 500 rupee SIPs. They're sort of trying and breaking that myth that you don't need to have large sums of money to be able to do an SIP, right? I think that is one myth that every AMC is trying to break. You can start with as low as 500 rupees. What matters is you contribute and you contribute consistently and you don't break that habit, which is what helps you grow wealth in the longer term. Right? This SIP amount can be invested in any mutual fund of your choice. But the bigger question that I want to ask you right now is, how do you think SIPs are a smarter version of RDs? Any points? You can put your thoughts in the chat box. I'll wait for a few answers. The question is, in your opinion, how do you think SIPs are smarter version of RDs? SIPs return can beat inflation rate. Okay, that's one very important point. Using the dull market and building corpus and waiting for reaping time. More returns than RD. All right. What else? What else do you think differentiates an SIP from an RD? Market related return. All right. That's a very interesting answer. Risk. Are you saying the risk is more or less? RD interest credited annually, compounded annually, but SIP returns compounded frequently. That's a very interesting point. Okay, super. Most of y'all, covered the points. So why SIPs are better versions of RDs? First, your money is invested in market-linked products, okay? Not locked in a fixed rate account, right? Which takes me back to the point that one of you said, that market-linked returns, right? It is governed by the market. There is no... See, now this market-linked return can be very positive, right? Now, where an RD gives you 6 to 6.5 or 7% return, because of the link with the markets and how the markets are performing, you might even end up making a 12 to 15% return in equity markets, right? So instead of settling for something like a 6 to 6.5%, why not try a smarter version of the same thing and start an SIP where you can actually earn more, right? So it gives you the potential to earn the higher returns, especially over long terms, which is very similar to what one of you said, that RD interest is credited annually, right? But SIP returns, they compound more frequently, correct? There's a question. We may get 12 to 15% returns, but not every year, right? See, that's again the risk of the equity markets, right? Conservatively, you can expect 9 to 12% for sure. 12 to 15% is definitely only a best case scenario, right? Generally, we do RDs for short-term goals. I agree, but now you have more a tax efficient option in mutual funds, the hybrid category. You have something called an arbitrage fund, which will help, right? Which are also for these short-term liquidity needs in that 6 to 12-month investment horizon period, etc. Right? So now, unlike in RD, where the rate of return is fixed, SIP returns, they fluctuate. But over time, I mean, I think from all of the data that we get to see and hear, the average return has been definitely higher. Right? Historically, we have seen conservatively 9 to 12%. Best case, we can see 12 to 15% or even more. And just like RDs, SIPs promote that discipline, that habit, that consistency, right? So yes, SIPs are definitely like RDs, but they are made and upgraded for long-term wealth creation. And it also definitely gives you better returns. Let's just quickly look at some math. Okay, let's say you invest 5,000 per month as an RD at 6.5% versus 5,000 per month in an SIP at which gives you 12% CAGR, right? What happens in 5 years versus what happens in 10 years? A lot of you may be thinking that maybe this is not the right comparison, but what you have to look at here is with an RD, you're settling for a lesser rate of return as opposed to an SIP. That's the only thing you have to keep in mind. And compounding will do its job. In 5 years, this 5,000 per month will grow to 3.5 lakhs in an RD, but it will grow to 4 lakhs, close to 4.1 lakhs in an FD. So that is essentially what? 60,000 more. You're getting 60,000 more if you do an SIP. Similarly, 10 years, compounding is double, right? It's twofold, it's threefold, it's 8.5 in an FD and 11.6 in an SIP. That's almost a difference of 3.1 lakhs, right? So compounding is what makes SIP a much more sought after option as opposed to any other instrument. If you consistently invest and expect the bare minimum return, the conservative return of 9 to 12%, and just keep at it, your wealth is going to compound very fast. Initially, what the goal that you get at maybe will take you, say, a year, two. But from there to the next goal, compounding will do its job. You might take 6 months. And from there to the next goal, 3 months. From there to the next, a month. And before you know, you would have reached your first goal, which is the idea of Milestones to Wealth, right? The program that we're running here at iThought called Milestones to Wealth. We have a lot of clients. We've helped a lot of clients reach their first crore. We've broken the whole journey down into several milestones because people might feel like 1 crore is too far away. I don't think I can do it. So we broke it down for them. We said, first you get to your 2 lakhs, and then, we'll see 5 lakhs, and then 10, and then 20, and then 50. And before you know it, you've got into your 1 crore. Right. So now that is the power of SIPs, and that is what we will help you do at Milestones to Wealth. Right. So this difference in 3 lakhs over 10 years, so without increasing, and this is without increasing your monthly savings, right? You're just simply putting in your monthly savings. That's the power of higher returns compounding over time. Even if the SIP gave you only, say, 9% instead of 12, you'd still beat you would still very comfortably be able to beat the RD. This is where we actually get to see the true power of SIPs. RDs, the common phrase that we get to hear is that RDs protect your money, but SIPs help your money grew. So this is just a small table to illustrate the power of SIP, and if you're able to step it up, how it can help, right? And this shows the time period within which you're able to reach your first crore. We're assuming 10,000 SIP, and with say an annual return of 10%, an annual step up of 10%, and you're assuming 12% CAGR, right? So in about 15 years with this 10,000, you're able to reach your first crore. And if you step it up by 10%, you're able to reach it in 12 years. Another 10%, so it keeps reducing as you're able to step up your contribution to your investments. And with compounding doing its job, you're definitely going to reach your goal faster than you think you will, right? So this is where we get to see that even that 1% makes the difference, right? Say you contribute, this is something that's very underrated, the power of just 1%. So when it comes to compounding, even a small difference in return, it makes a huge impact over time. So quick example, let's take 5,000 per month at 6% for 20 years, at 7%, 8%, and 12%. So this 1 to 2% increase may not seem like a big deal in the short term, but stretch that out over 10 to 20 years. And the difference is in lakhs of rupees, right? And that's why SIPs make sense. Now look at this chart itself. 100 invested in 2019 at 5%, 6%, and 7%. In 20 years, this 100 goes to 265 at 5%, 321 at 6%, and 387 at 7%. So that 1%, that underrated difference of 1% makes all the difference in your investment. That is why SIPs make sense. So they essentially give you access to higher potential returns. Even if you earn just 1 to 2% more than an RD, the compounding effect can transform your financial future. That's smart saving, right? So the SIP way is always going to help. So this is just a small chart to illustrate, if you're confused, which investment vehicle to use, to show you how a bank RD versus gold versus SIPs have done. Of course, mutual fund SIPs have done significantly better in various time periods. Of course, we have gold that comes in and then only RD. And like you all said, RDs are definitely more useful for short term, but we have better alternatives even in the equity mutual fund category. We have a hybrid category called arbitrage, which helps you sort of deal with all of this. For every year, I pay term insurance around 20,000. Based on that, I invested in RD for 1 year. Per month, okay, could you please suggest which fund you would suggest? Arbitrage is definitely a good option, sir. If you're looking at, having liquidity and, I want to put this money so that it's easy for me to take out, arbitrage is definitely a good option that you can look at. So now coming to why SIPs win over the long term and why it's even better than an RD. First and foremost is the power of compounding. So your return earns return. So your money earns money, and the longer you stay invested, the more your money grows. Second, Rupee cost averaging. Rupee cost averaging essentially means when the markets go down, you buy more units. When they go up, you buy lesser units. Very simple math. And the price is low, you're able to buy more. Price is high, you want to buy less. And over time, this volatility averages out your cost, and it takes the guesswork out of being able to time the market. Okay. Next, we have higher average returns. SIPs, they typically earn more than RDs or FDs over a 5, 10-year or, a longer period also. And you're participating in the growth of the economy, which is what drives the return in these markets. Of course, it's flexible and adjustable. You can increase, decrease, pause, or even stop your SIP at any time. And it is goal based and long term. So you can link your SIPs to different goals, say children's education, down payment for a house, retirement, vacations, etc. And it can help you systematically plan and achieve what matters most. So you can prioritize your goals and invest in those funds, invest in funds accordingly to be able to achieve those goals, right? Now, for all of these reasons, SIPs it makes SIPs not just a tool for saving, but also a strategy for growing your wealth with discipline. So the SIPs basically combine, market potential, compounding power, and behavioral discipline. The markets may be volatile, but these SIPs let you participate in that in the growth without trying to time the market. And plus, another thing is that these SIPs remove the biggest roadblock to investing, which is inconsistency. So you're investing a fixed amount every month. You remove emotion, fear, procrastination from the equation. That's what SIP. So when you sort of start doing SIPs, it builds that discipline in you, and you're able to remove the whole factor of emotion, fear, and procrastination from your equation in investing. And you build wealth quietly, steadily, and automatically. And most importantly, SIPs in the long term, it rewards patience. So the longer you stay invested, the more powerful the results can be. Right. So this is what we do here at Milestones2Wealth. We break down a bigger goal into several small goals and help people achieve their first crore. So I would strongly encourage you to, start taking stock of how much you're saving, how much you'll be able to invest, and we'll be more than happy to help you all reach your first 1 crore. And this brings me to the end of the webinar. If you have any questions, I'll be more than happy to take it.